I'm Marilla Fernandez. Welcome to Market Call, and thanks very much for joining us. Eric Nuttall on the show today, partner and senior portfolio manager at Ninepoint Partners, taking your questions today on energy stocks. Here's how to reach us. Call us toll free 1-855-326-6266. You can also send an email to marketcall@bnnbloomberg.ca. Eric, thanks for coming in. We do need to talk about the just landed news from Donald Trump, of course, that there will be a 50% tariff on steel and aluminum, and that starts tomorrow. So wondering if you see this rippling through pretty quickly to a number of sectors, and if so, which ones?
You bet. I think it speaks to the enormous amount of volatility that investors in all sectors have to deal with, especially in energy. Concerns about demand growth now are becoming more front and center with all the tariffs being implemented. And I think it's one of the reasons why there is such a massive disconnect between where oil is trading today versus what we see fair market value to be. By our estimates, this difference between those two markets, the paper market and the physical market, is the widest that we've ever seen. It's well over $15 a barrel. And I think it's owing to a lot of the uncertainties, the volatility, the lack of ability of crude traders to actually deploy risk capital to narrow that difference. And at the same time, it's so important for energy investors to believe what you see and not what you hear. And by that, I mean we're being bombarded with what we think are false narratives. Just yesterday, the Secretary of Energy of the United States is down at CERAWeek down in Houston saying, we want $40 oil, we want $50 oil. But at the same time, shale companies are going to magically grow production and add to 3 million barrels per day, et cetera. And if you reflect on, well, okay, that's what you hear, what do we see? What we saw last year was the oil price averaged roughly $76, $10 higher than where we are right now.
Sure.
And yet the rate of growth coming out of U.S. shale was actually the slowest outside of COVID since the rise of U.S. shale. And so to magically think suddenly we're going to get this surge of production with a meaningful lower oil price is a false narrative feeding that narrative.
Okay, so given that, what would they dip their toes into? Meaning, what would they up production at? What price is the sort of that magic number?
It's about $70.
Okay.
We were expecting about 300,000 barrels per day of growth this year. In fact, we think that U.S. shale is approaching its peak production rate over the next year to 2 years. But you cannot get lost in that messaging. What's important is the rate of growth going forward is meaningfully lower than, say, the last time Trump was in office. Well, shale was growing by 100,000 barrels per day. So in the context of demand growth this year of roughly 1.2-ish million barrels per day, that loss of shale production now allows OPEC Plus to slowly bring back curtailed volumes onto the market, as they've said, beginning in April's time. And, again, if you look at the amount that they've declared versus what's official, again, what do you see versus what you hear, if you account for where certain producers are overproducing and have been, it's only about 1 million barrels per day of actual real barrels to come onto the market over the next 18 months. And OPEC has talked about their desire to be very adaptable and market dependent, et cetera. And so there's so many false narratives that are feeding the sentiment. And when you look at either the amount of investment by part of hedge funds, I saw a stat yesterday, we're now back down to the lows of COVID. And so people are as negative towards oil today as they were when we were all locked in our homes and we were doing this virtually. So it's staggering to me that sentiment is as weak as it is. And I think the uncertainty is creating massive opportunities, many of which I'm sure on this show we'll talk to.
We will. I'm sure people will have a lot of calls about that. It's just getting people to sort of switch over to that, right, without panicking first about
Very
the
much
money
so.
loss.
And the panic is real.
Yeah,
we feel that.
Absolutely. Okay, we are going to be back with Eric Nuttall. He is partner and senior portfolio manager, Ninepoint Partners, taking your questions today primarily on energy stocks. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. We have Eric Nuttall in-house to take your questions. First, we'll go to an email from Sid in Vancouver. Sid writes this about Parex Resources. Can I get your guest thoughts on Parex Resources? Should I continue to hold or should I sell? We'll take a look at where Parex is today in just a moment as we pull up the line graph. There we go. So it has dropped 40% year over year, now hovering around 12.5, 12.6.
There's no reason to own Parex. You should sell it, especially if you can realize a tax loss and deploy the funds into a better name. They were a complete disaster last year. They incinerated hundreds of millions of dollars on a new area in Colombia that proved to be non-productive. They're now deeply in the penalty box. We are in a risk-off market where people are looking for reasons not to own a name. There's no money left to defend a name like this. And so, yes, it is inexpensive. My view is it's a value trap. We'll have three other names later on where we see meaningfully higher upside with meaningfully less downside.
Got it. Okay, get rid of Parex at this point. Let's move on to the phones. We have Wesley on the line at this hour. Wesley is calling today from Toronto. What's your question?
Hi. Thank you guys for taking my call. My question, in your professional opinion, what are your thoughts about Tamarack Energy, and more specifically, how does the net effects of FX change the company's WTI break-even per barrel on these set of companies versus Canadian dollar versus the U.S.? And if there is time, if you can briefly touch upon how this will also affect producers in light oil versus heavy oil.
Okay, so Tamarack, year over year, up 15%, but has been taking a hit since the start of the year.
So true of the sector. So we've been adding to Tamarack very recently. We remain one of their top shareholders. It'd be about an 8.5% weight in my main fund. What we like about Tamarack is the majority of their production is now exposed to the Clearwater, which is one of the most economic oil plays in North America. Even at $70 oil, so kind of roughly where we trade today, the time with which they get their investment back on a well basis is measured in months. Like it'd be 10 to 11 months for payback period. So they're super economic. As Wesley pointed out, Tamarack, and in fact most companies, all companies, are benefiting from the weak loonie because they're selling in USD, repatriating that back, and yet their OPEX is in CAD. So that's a very significant tailwind. When we look at this name, we have it trading at 3.3 times cash flow this year, 2.8 next. More meaningfully to me is the free cash flow yield because they're using that to aggressively buy back their stock. And so we would have an 18% free cash flow yield right now. Very, very compelling, 20% forward, meaning you're getting a just under 4% dividend yield plus remaining buybacks. And they have well over 20 years of stay flat inventory. And at the same time, you're also getting a current valuation by our estimation, absolute free upside to their water flooding. So that's using water flooding to increase pressure, recover barrels. It's costing them roughly $6 to find and develop a water flooded barrel. So the economics are they're mind blowing. So we think it's materially mispriced, as is the sector. We would put a 5 target multiple that would suggest about a $7 target price 1 year out at $70 oil.
Got it. Okay, a lot of information to digest there. Let's move on to John, who's calling today from London, Ontario. Hi, John.
Thank you, Marilla, for timely and tariff-free business television. Eric, CES Energy Resources, you put me onto it. I think it was about $2. It's had a great ride. It does a lot of work in the U.S. And the question I have to ask on top of that is, what about tariffs and CES Energy Resources? Thanks very much, Eric. Have a great day.
Yeah, let me interrupt you just for a moment, because I think there's a lot of, not a lot of clarity, we'll say, around what products are going to be tariffed. And I know some of that changes routinely out of Washington. Yeah. But we know that there is an energy tariff of 10% from the U.S. And if things are covered under the trade deal, they're not tariffed. But is it clear from that direction what products are going to be marked up 10%?
At this point, no. And honestly, I think tariffs is a massive distraction. So even if you assume 10% tariffs on Canadian oil, we did the analysis, it's about a 7% hit to cash flow maximum. And that was assuming that the loonie doesn't fall further, which we think is reasonable, right? Like if a 10% on energy means a 25% on everything else, the loonie is going materially lower. There is actually a scenario that I can paint where cash flow is actually higher under tariffs, given the magnitude of the likely magnitude sell-off in the loonie. So tariffs are actually potentially positive for Canadian oil and gas companies. That's very non-consensus. Okay. So honestly, it's complete noise and it's a distraction. Our base case remains that tariffs will not be in place for long, even if they are, because essentially it's a direct tax on the U.S. consumer, had two refineries in the Chicago area import in 3 million barrels per day of Canadian heavy via pipeline. You can't barge, you can't truck other sources of 3 million barrels per day. And in fact, globally, they don't exist. So that's about a 17 cents per gallon tax on the U.S. consumer, which equates to $22 billion of less consumer discretionary spending. So it's complete idiocy. It achieves nothing. We don't think it will be in place because it's massively inflationary. On CES, so I'm glad you did well. We did very well on the stock too. We have sold it because our interest in holding service stocks right now is low. We do not see the U.S. rig count and by extension activity increasing in oil going forward. We think gas, ultimately the call on gas production growth is there for the second half of this year and into 2026. But we just think pure play natural gas and or oil names will do better. They're benefiting from the Schlumberger acquisition of ChampionX. They're gaining market share. You've seen their margin expand to roughly 17%. They're now talking about the billion-dollar market potential of offshore, which they've never had progress with before, so that's a new market for them. The stock remains inexpensive, as is the entire sector. So we have it at a free cash flow of roughly 19%, 4.4 times, where ChampionX, I think, got taken out at 8 or 9 times. So we see meaningful upside. We just, thematically, we want to be more in pure natural gas names or oil names right now.
Got it. Okay, we do have to take a quick break here on Market Call. Eric Nuttall's in-house today with your questions on energy stocks. Back in a moment. Welcome back to Market Call. Thanks very much for joining us. We're going right to the phone lines. David has been holding on the line from Ottawa. Hi, David. What's your question today for Eric?
Yes, good afternoon. Thank you for taking my call. My question is on CNQ, and although it's one of the best energy companies in Canada, if not the largest, I don't understand why the stock price is at a 52-week low. It's been declining most of 2024, and it's still going down. Do you own CNQ, and are you a fan of this company? Thank you very much. Have a great day.
Yeah, so CNQ is about a 10% weight in my fund. There's a few reasons why it's being sold off. So you have to appreciate it's non-fundamentally based. First off is Canada is for sale. The Canadian market at large has been for sale since January due to Trump tariffs. Secondly, energy is for sale, again, owing to oil tariffs. And CNQ would be one of the more exposed companies. I think there's been a pair trade where investors have been going long Suncor and short CNQ as they don't have the benefit of refinery exposure, not nearly as much as a Suncor. And so we actually own Suncor. We sold it and bought more CNQ with it. As you correctly point out, CNQ is one of the deepest reserve bases of any company on the planet. If we're directionally accurate that U.S. shale is peaking in the next couple of years and non-OPEC supply growth is peaking in the next 2 years as well, there's going to be a massive seek for companies that have deep, deep reserves as the demand for oil is going to grow much longer and stronger than consensus believes. CNQ will be a prime beneficiary of that because it's large enough for any institution on the planet to be able to take a sizable stake. We look at it trading at 6.4 times cash flow at $70 oil, an 11% free cash flow yield. We're getting about a 9% cash return. That's between the dividend and the share buyback for a company with well over 50 years of stay-flat inventory. So we think it's been massively oversold because of the sell energy, sell Canada themes, and we're taking advantage of that. We can't buy any more because it's at our fund max weight.
Got it. Okay. So hold on to that. We'll move back to the phone line. Silka is on the line from Toronto. Hi, Silka.
Hello?
Hi, Silka. What's your question today?
Yes. Oh, I have a question regarding Freehold.
Go ahead. Okay, I'm not sure.
Probably should she own it or not would be my guess. So Freehold continues to be a large weight in the energy income fund that we manage. It's now yielding 9%, which is astounding to me. Some of the dividend yields are phenomenal. This company, that would be defendable well below current oil price. I'm cuffing this, but roughly $5 and probably $2 gas. So it's a royalty co. You're not taking exploration risk, capex risk, etc. They just receive checks in the mail on a monthly basis. They have shown the ability to expand into the United States. I think critical in their next quarter will be hopefully showing a stabilization of U.S. volumes. They've continued to do accretive deals in the United States because running room in Canada is not as deep. So I look at it a name where, capital appreciation, I've recommended this in the past, and we've always framed it the same way. you should be looking for modest capital appreciation. It will always lag a pure play E&P. But at the same time, you're getting a 9% dividend yield, which we believe to be phenomenally stable. And you're getting the ongoing, hopefully, accretion of M&A in the United States. So again, if you're an income investor, you're looking for a pretty juicy yield that's fairly defendable with modest upside appreciation, we think it's a great name to own.
And where are they expanding in the U.S., or where are they looking to expand?
Largely the Permian. That's really the only basin of size and scale with growth prospects is the Eagle Ford and the Bakken are either flat or in decline.
Got it. Okay, we'll go back to the phones. Tom's on the line from Kingston today. Hi, Tom.
Thank you, Morella. I bought New Vista because I believe it has a good chance of growing with this new pipeline that's going to Kitimat. I believe it's well positioned to profit from this. Is ARC a better choice?
Right.
And my second question, I give you a bonus question. Why isn't there why is no one talking about a pipeline to the Hudson Bay coast?
Okay.
We could have done a lot of things with that.
Tom,
anyway,
okay, thank you.
Listen.
All right, we'll wrap it up. So, Tom, Hudson Bay doesn't work. It's only 3 months a year where you've got free seas, so the economics of a pipeline don't work because the amount of icebreakers and such. On New Vista, we remain one of the largest shareholders. I think we're second after Paramount. We think there's a deep value in this name. We continue, I think it's be roughly a 10% weight in our fund. What we see is a company that is going to be growing their production by about 50% over the next 5 years, while free cash flowing roughly 70% to 80% of their current market cap over that time frame. And when they get to a peak plateau production of about 120,000 BOEs per day, they then have the inventory to keep that level flat for almost 30 years. So as they're growing, we're getting free cash flow back to the shareholders. But at the same time, once they reach that peak in a several years' time, the amount of free cash flow is going to be mind-blowing to us. And so we continue to add on every opportunity. Whenever it dips below a 10%, we see roughly 50% upside on a one-year basis. But looking 1 year out on companies with decades worth of inventory, I don't think does it justice. And so we're going to be patient to allow Mike and his team to realize the value, and we're going to be sticking with this one.
All right, let's go back to the phone lines. We have a Florida caller today. Jack's on the line. Hi, Jack.
Thank you for taking my call. My question is on Chord Energy. I held Enerplus, and when Chord bought Enerplus, I bought Chord.
Yeah.
And I've been underwater ever since, so I'm wondering if I should hang on or take my loss and move on. So,
yeah, so if you think
I'll
Canadian mid-caps are out of favor, welcome to the United States. Like there's just been, when you're only 5% of the market, not 18%, there is just no buyers because the energy names to most generalist investors in the U.S. are completely irrelevant. And so not only that impact on Chord, but also this effect of Enerplus shareholders getting Chord stock, not knowing what to do with it. So they've been selling that as well. So what you're getting with Chord is a company with at least 10 years of stay-flat inventory. So not decades and decades, what you get in the oil sands, but for a U.S., well, I'm going to call them a shale company, that's pretty good. The name's trading at a 14% free cash flow yield. They're returning at least 3/4 of that back to shareholders, predominantly in the form of buybacks. It's trading sub 3 times. So it's deep value. My challenge, though, is you need a U.S. investor to care, because Canadian investors likely are not, because we have adequate opportunities north of the border. And so it's kind of stuck. I can't quite see the catalyst to drive a meaningful re-rating other than a meaningful increase in the oil price, which honestly we don't see happening for the next year or so.
Got it. Okay, Eric is sticking around to take your questions on energy stocks, but we're taking a quick break. We're back in a moment. Back to Market Market Call. Thanks for joining us. Time for our guest past picks. Eric Nuttall's past picks are from April of last year, so April 2nd of 2024. And right off the top, a winner, Varen, of course, which announced the merger this week, and so was up by quite a bit, although Whitecap went down. So let's take a look. At the time, you recommended it. It was 11.52. It's now 8.49, and returned of minus 26 and minus 23. So obviously some fluctuation there. Tell me why you picked Varen at the time last year.
Yeah, so Varen was in the pole position to gain kind of that mid-cap status of investable. They had finished several years of acquisitions. They'd built meaningful inventory. They were drilling some of the most economic wells ever drilled in the Montney. Later last year, they went on to try a different frac technique using a different tool that failed to work. And so they overcapitalized one area. It was a risk-off market. People condemned the value of all of their acreage on that. And so we meaningfully added to our exposure. We owned 20 million shares heading into the news on Monday. So I think we're their largest shareholder, their largest active shareholder. More importantly, though, is, okay, we've got the deal. Whitecap. My view is Whitecap, I know the headline premium was high of 39%. My view is Whitecap was almost stealing the asset. And I think they're being very opportunistic in their timing, as they should, because I think they saw what we saw. And that was the technical merits of the team at Varen identified very high quality rock. Undoubtedly, they screwed up. They owned it, and they've been digging themselves out from that. Subsequent to year end, we've had a reserve report with no technical revisions. So the reserve engineers validated our view, and my partners, Via Keegan, who spent a lot of time with our technical team. After that, they've drilled a very boomer pad, and we thought they were a month away from releasing well results that was going to completely validate our view. And so my guess is Whitecap drove the bus in terms of timing. This merger between the two is very complementary. There's very strong asset overlap. And it could have been either management team leading the pro forma entity. I just think given that Varen was still in a period of or situation of somewhat weakness because the market hadn't fully seen what we saw, it ended up being the Whitecap team. And so we think they're getting a very high quality asset at a reduced price owing to market volatility. We think that size and scale matters. Mid-caps have been left for dead by large institutional investors. And so becoming the 6th to 7th largest producer in Canada with a 9% dividend yield that's sustainable down to $51, we think will force large institutions to look, because at $70 oil, pro forma, they're trading at about 3.1 times cash flow, a 17% free cash flow yield, a 9% dividend yield, and they have well over 20 years of stay flat inventory, and that's very high quality inventory. And so we see the strategic benefit over time. I cannot intelligently explain why Whitecap fell by 15% yesterday. I think there were other factors to that. And we think given they're going to be on the road for the next 3 weeks, selling the sizzle, explaining the strategic rationale, talking about the synergies, et cetera, we see Whitecap recouping a lot of yesterday's losses, and by extension then Varen more closely reflecting a 39% premium.
Yeah, it was interesting to see Varen get a bump and then Whitecap go down in the opposite column, but we'll see what happens in the next days and weeks ahead. Let's go to your next top pick from last April, which was Baytex. It was recommended at $5.30. It's now down to $2.89, so a dropped return of 46%, 45% for the total return. What happened with Baytex?
So drill bit-wise, execution-wise, they did exactly what they told us that they would do. You've seen massive multiple contraction in the small and mid-cap space. We exited at about $3.85 to $3.90. We had a distribution that we generated over $100 million of gains last year, so we had to distribute that to our clients. We had to minimize that. This was one of the names that we had losses on. It's effectively in an air pocket now, where it's just been falling on no natural buyers as energy is out of favor. It's deeply contrarian. The stock is undoubtedly inexpensive, 2.6 times cash flow, a 24% free cash flow yield. They're using half of that free cash flow to buy back their shares. They pay a modest dividend. There are just, for a fresh dollar today, I think there are other names that will probably lead first. But I think Eric Grieger and his team have been executing on exactly what they told us that they would do. The quality of the acquisition that they made, God, is it 2 years ago now? I think they validated that. But it's in a sector of the market that is totally out of favor.
Would you dip back in at all? at this?
Every day is a new day.
Okay.
So they do have a large shareholder. I would say in a slightly higher oil price environment, this name really hums at 75. So if I thought we were going to be at 75 and sustainable, so let's say a year from now, there is an overhang. There's a large shareholder with 11 to 12% of the stock. That's an overhang. I like opportunities where we can make a call, we can take care of an overhang and lead to a multiple expansion. Every day is a new day.
Got it. Okay, let's go to your last pick from April of last year. Precision Drilling recommended at 96.01 and now down 63.43, 32% drop for both return and total return. Where did Precision Drilling go wrong? What happened there?
Yeah, so you see a theme here. And I will say, I've been doing the show for, I think, 14 years. You want to buy a sector when the guest looks like a complete moron. And so that's me right now. What happened to Precision? We bought 9.9% of the company at roughly 75. It rallied into 110. We exited it at $88. Services have been selling off meaningfully as gas was weak not that long ago. Oil was weak. Discipline remains. And the challenge with drillers is they've gotten too good. They've become too efficient. So E&Ps are drilling wells with less time, i.e. less demand for the rigs, but they don't increase the number of wells because investors want capital discipline. And so they've kind of shot themselves in the foot by becoming too good, and they are not getting the economic rent of that. The producers are, hence why I don't own any service companies right now. I will say it is getting tempting. I asked my partner Keegan this morning, how do we feel about the numbers? We feel pretty good. It's trading at 3 times EBITDA and a 32% free cash flow yield. That's pretty damn compelling. That's in fact the same metrics as when we initially bought the stock. So my challenge as a fund manager is there are so many opportunities that look extremely compelling. We'll outline some later. Where do you want to go? What do I want to own now is I want to own natural gas, predominantly in the US, and I want to own oil companies in Canada with decades worth of inventory at a time where we're nearing peak shale, where we're getting all of the free cash flow back in the form of buybacks. Those are my two main focuses right now.
Okay, and we'll take a look at your forward picks a little bit later. Right now, a quick break. When we come back, Eric Nuttall will take your phone calls again on energy stocks. We're back in a moment. Welcome back. Let's get right to your phone calls. Daniel is on the line today from Markham, Ontario, with a question for Eric Nuttall. Daniel, what is your question today?
Hi, Marilla. Hi, Eric.
Hi, Daniel.
May I have your thoughts on Headwater exploration? Does it match your investment thesis of great management team, quality assets, free cash flow yield, and buying back stock? And do you personally own it? Yeah. And as usual, one of the best and favorite guests on Market Call. And
thank you.
Marilla, great host. Thank you.
Thank you.
No, I've been warned we have more callers than we have time, so I'm going to try to be pretty punchy. So when I have questions, let's do the same. Headwater is an exceptionally well-run mid-cap, small-cap oil company that's yielding 7.5%. Jason and his team have done a phenomenal job of aggregating assets. I don't own it in the fund or personally. It's just I can only own 70 mid caps. And so there's other names where perhaps from a valuation perspective, it's a little more intriguing to me. Headwater, they've done a great job in the Clearwater, super economic, similar to Tamarack. I would favor Tamarack over Headwater for Clearwater exposure. They also have several exploration plays with which they've had success on so far to expand their asset base. And so if you're looking for modest production growth combined with a very juicy yield, we see meaningful upside, roughly $9 target, 57% upside from here. There's just so many mid-caps that I can own in the fund. So we're really calling non-core names, and we've really tightened. My top 10 would be 89% of the fund right now.
Got it. Okay, let's go back to the phone. Bill is on the line from Toronto. Hi, Bill.
Hi there. Thanks for taking my call. Eric, I believe the last time you were on the show, you mentioned Lycos Energy as being one of those stocks where the street just doesn't understand its true value.
Yep.
Do you still own it, or did you own it? And would you be a buyer at these prices?
I would,
below $2. Thank you.
I wouldn't buy it. It's a small cap company for which there are no buyers. I think we own 10% of the company. That's a whopping $10 million position. It's 1.7 times. They're growing. It's amazing. If you pull up the stock chart, it's just been creamed. And yet they've done everything. They've done everything that they've told us. So it's probably down 40%, give or take. We're down 35%. They've executed phenomenally well. They continue to delineate, expand, et cetera. So they're pursuing strategic alternatives, i.e. they're going to sell the company. We are strongly in favor of that. We're hoping to get paper in a larger entity that could reclaim some of the lost value. So the team's done nothing wrong. It's just this is a small cap that remains out of favor. The small cap model in Canada is dead. And so I think we all just have to recognize that and move on. So the team's done nothing wrong. It's just they're a victim of profound apathy towards small cap energy stocks in Canada for 2 years now.
Lycos is LCX, so they're down to $2.03. Does that sound right?
Yep.
Okay, got it. All right, let's move on to Mike. Mike is calling from Montreal. Hi, Mike.
Hi, how are you? Is it possible to have Eric's opinion on Cenovus Energy? With being like one of the top 4 largest oil companies in Canada, do you still view it as you plan on going back to it? Because I know you held it in the past.
Got it. Okay.
And would you be able to comment on the downstream impact from Q4? Right. And we remain bullish. Have a good day.
Thank you.
Cenovus, we think, is a bit of a value trap. I never thought I wouldn't find it overly compelling, below $20. In January, they gave an investor update and said they needed another 2 years to fix their downstream to be competitive with pure play refiners. And so that the ultimate catalyst that we've all been praying for and waiting for to get them to reclaim their lost multiple is just being deferred and deferred and deferred. They've been incredibly timid in terms of their pace of share buybacks over the last couple of months. And so we see better upside in CNQ today. Is the stock cheap? Absolutely. It's 4 times cash flow, 11% free cash flow yield. They're buying back, or theoretically, they're supposed to be buying back stock with all that free cash flow. It's just the downstream continues to bite them in the behind, where it was negative EBITDA. So yes, while it's only 15% of their total corporate EBITDA, when it's negative, that's a bit of a problem. And so we're really hopeful. We're rooting for them. We see nothing wrong with the management team, et cetera. It's just it's delayed gratification in a challenge tape where people need certainty in terms of when that catalyst is going to be. And with turnarounds now, we're going to be waiting till Q3 at the absolute earliest.
Got it. Okay, we have to take a quick break. We're back with Eric Nuttall in a moment, taking your questions today on energy stocks. Back in a moment. Welcome back. Eric Nuttall is our guest today. He's taking your questions and your phone calls. Greg is on the line from Amherstburg, Ontario. Hi, Greg.
Hi, how are you doing?
Okay.
I wanted to ask Eric about Advantage Energy. I've held it since before COVID, and it's run up quite a bit, but I think it's at a plateau, and I wonder if you think it's hang on to it.
I would sell it. I think there are far better names. The CEO and the board did one of the worst acquisitions in Canadian modern history at a time when people were warming up to natural gas. They went and added liquids exposure. Since the last time we'd ran the analysis, from the time of that acquisition, they are the worst performing natural gas stock in North America. And so we just don't see the upside. They have an activist that has just entered the name of, I believe it's Kimmeridge, they own 6% of the stock. They've put some members on the board seeking strategic alternatives. In a post-ESG world, we don't see the value for Entropy, which was once heralded as going to be this massive catalyst. We believed at one point, when we actually did own the stock, that they had good natural gas reserves and inventory, but their acquisition shaked our confidence in that. And so as investors are increasingly warming up to natural gas, as they realize that natural gas is not a bridge fuel, it is the fuel of choice going forward, our strong inclination is to get more exposure either in the United States. We're very large shareholders in EQT and Expandus too. And in Canada, we prefer natural gas with some condensate kicker, such as ARC and NuVista. We do not see the investment thesis in Advantage.
Got it. Okay, let's go back to the phone lines. Peter on the line from Toronto. Hi, Peter.
Hi, good afternoon, all. My question, Eric, is on Devon Energy. The next quarter or two, in terms of a trading stock, what do you foresee for that company? I'll hang up and listen.
We don't buy companies for quarters. Devon underperformed meaningfully last year. From an execution perspective, they've been righting the ship after many quarters of disappointments. We see the stock as offering deep value, trading at 4 times. roughly a 15% free cash flow yield. We're still a little worried about inventory depth, specifically in the Permian. So if I contrast a Devon with a company like a CNQ, where I'm getting way better inventory depth, way better execution, more higher dividend, triple the dividend, more share buybacks, I would strongly favor Canadian oil companies. I cannot find more attractive opportunities than Canadian oil sands companies today. You get the benefit of decades worth of inventory, rock solid balance sheets, strong execution, excluding Cenovus in that conversation, of course, and meaningful share buybacks compounding over time.
Got it. Let's go back to the line. Liam on the line today, calling from Calgary with his question. Hi, Liam.
Hi, how you doing today, people?
Well, thanks.
Great to hear you on the show today, Eric.
Thank you.
My question follows up on the last two comments you've made regarding oil sands majors. In light of the recent Whitecap Varen consolidation in this downgraded environment, which again is paper versus real barrels, my question is, some of these oil sands are strong and some of them are very weak. And I'm not going to mention names. And I know you don't like to comment on consolidation, but could that potentially happen in the oil sands?
You could see it. When you look at names that have stumbled, like a Cenovus, names that have executed well, like a Suncor, where Rich Kruger, I think he was just nominated CEO of the year, and he sure as hell deserves that. He's done an unbelievable job. Any of the doubters, he's silenced them with very, very strong execution. So Suncor could be an acquirer. When we look at values, opportunities, you've got Cenovus. Would make a lot of sense. Suncor's done a terrific job of taking the market's focus off of base mine depletion, which is an issue down the road, 8 to 10 years from now. We other two other oil sand names, which we'll talk about in 5 or 6 minutes' time, where we also think they could be feedstock. So Suncor has regained its lost multiple. It now trades at a slight premium, certainly to a Cenovus. We could see them being an acquirer. We hope they won't, because we don't own Cenovus, but we own two other names that would be natural fodder for them, and we would prefer to benefit from meaningful share buybacks over time, where we see more than 100% upside in each of them over a couple of years' time. We'd rather not see like a Varen, suppose you make 39% overnight when you see more than 100% upside over time. But we think the strategic value of oil sands is only going to be going up in a world where we have lost short cycle production from U.S. shale, where companies are not sufficiently investing, where demand's going to grow, we think, for at least another 15 plus years, and where even OPEC itself, due to challenges with OPEC spare capacity, I don't think they are able to answer the call on OPEC beyond the next couple of years. So we've got, I think, a really, really exciting opportunity. We just have to get through the next 9 months to a year. And so the value of Canadian oil sands at large, I think, is only going up.
Okay, let's see if we have time for one more phone call. Myron's on the line from Scarborough, Ontario. Hi, Myron.
Hi, Eric. Thanks for taking my call.
You bet.
And I was calling on the kelp.
Yeah.
It's well, I guess a small mid cap. I don't know how you're going to term it now, but seeing that we just had this merger again with Whitecap, which I'm a large shareholder. And also Varen. In light of what you said earlier, that
I understand
the small caps and mid caps are left for dead.
Yeah.
What do you think? What do you think of Kelt?
Yeah, so
and do you own it, or would you buy it at this price?
Yeah, we don't own Kelt right now. Again, there's only so many mid caps that we can own. We see the deep value inherent in the asset that Kelt has put together. Like Dave, Sadiq, and their team, they've always built this company to sell either part or all of, and they've done a phenomenal job in their last iteration selling to Exxon. We think that's down the road, whether it's the next 9 months, whether it's the next year. Well results have been improving, validating the value of the assets that they've acquired. It's just timing is a bit uncertain. So we can only own so many mid caps. We've picked our horses. It's not one of them for now. Every day is a new day. We see the value inherent in the assets, and we wouldn't be surprised if a year from now They're very different, looking similar to what Paramount did. They sold off most of their production, took cash to reinvest, and basically replace what they had. So we see the value, we're just not there today.
We will leave it there with Myron as the last phone call today, but don't go away. Our guest top picks, that's coming up next. Stay tuned. Welcome back. Time now for our guest top picks. Eric Nuttall's first pick on the list is MEG Energy on the TSX. Why do you like MEG Energy?
So MEG remains one of our largest holdings. It's roughly an 11% weight in our fund. It's sold off year to date, I think, primarily due to tariff worries. The concern that differentials for WCS, Canadian heavy oil, are going to blow out. Funny enough, they actually just hit, I think, a one-year low right now. So phenomenally profitable. The market is discounting the likelihood of tariffs reasons, which we've covered earlier on in the show. MEG over the next 5 years, owing to the depth of their inventory, we think they have well over 35 years of stay flat inventory. So over the next 5 years, they will grow production by 25%, while also buying back half of their shares outstanding, funded out of remaining free cash flow, while also paying a dividend. We see the stock at $70 oil trading at 4 times forward cash flow, a 13% free cash flow yield. We are bullish on oil for 2026 and beyond. And so they have very significant leverage to a rising oil price. If we just add on another $10, so we go from $70 to $80, they could not buy back half of their stock. They could buy back 80% of their shares outstanding over the 5 years, while also growing production. And so we think it's been heavily sold off. We are aware of active shorting from hedge funds around tariff noise. We think this is at least a $30 stock 1 year out if the stars align, but we see significantly higher value over time, because the biggest opportunity the market is overlooking now is the benefit of significant share buybacks compounding over time, because the remaining shares become more and more and more valuable, especially companies with decades and decades worth of inventory.
Got it. Okay, let's get to your next topic, which is Athabasca Oil. Why do you like Athabasca?
So this too is sold off. We've been adding on every opportunity. We would be one of their top shareholders. Again, similar to MEG, this company is going to modestly grow production over the next 5 years, while at the current share price, able to buy 68% of their shares outstanding at the current oil price. Massive leverage to a rising oil price. If we go from 70 to 80, they could almost privatize out of free cash flow. In fact, in 5 years from now, at $70 oil, because of the both growing their production and buying back their shares, they will free cash flow their current share price in 5 years' time. And yet this is a company with at least 50 years of stay flat inventory. And so we see profound upside, again, over time. I can give a 1 year target, but that doesn't really do the story justice. It's the compounding impact of retiring shares month after month, quarter after quarter, year after year, and that is exactly what they are doing. Shareholders are getting 100% of that free cash flow back. And so even just at a flat oil price, they'll go from a 3.9 times multiple this year to 3.2 next year to 2.2 in 27, 1.4 in 2028, and 0.3 times cash flow in 2029. That's at a flat oil price at $70 oil.
Okay, we're at 66.50 today as we check and move on. Let's go to your last pick of the day, which is ARC Resources. Tell me about ARC.
ARC is our favorite way to get Canadian natural gas exposure. They just signed a great deal with Exxon, where they'll now be selling 25% of their natural gas at international pricing. What you get with ARC is deep inventory, decades worth of stay flat. You get a board and a management team that have done a phenomenal job of growing shareholder value over time. You're getting a natural gas stock at a discount relative to their U.S. peers. U.S. gas names at $4 NYMEX trade anywhere from 5.5 to 7.5 to 8 times cash flow. This company is trading at 4.6 times. And so you get a modest dividend, 3%. It's really the additional free cash flow going back to share buybacks. Plus, they've sanctioned phase 2 of Attachie coming in line in a few years' time. And so you'll get an uplift in terms of free cash flow once that comes online, too. And so we are bullish on the long-term, medium-term outlook for natural gas. We think it is the fuel, not of the future, but the fuel of today, given AI, data centers, mobile power demand, et cetera. And so using what we think are reasonable base case assumptions, we see very meaningful upside in ARC, not just over the next year, but over the next several years.
Okay, so, 20 to 30 seconds, people are responding, of course, to the tariff threats. They're seeing things drop. You're saying it's a lot of noise, but how would you advise investors?
Oil demand remains healthy. Global oil inventories are at their lowest levels, near their lowest levels in history. U.S. shale grew at its slowest pace since its inception. Drill baby drill is absolutely toothless. OPEC has much less spare capacity than what people believe, and it will be largely normalized in about a year's time. Natural gas is now in a multi-year bull market. We now have about a 45% weight towards natural gas in our fund. Free cash flow is massive. Stocks have been walloped on sentiment challenges. Believe what you see, not what you hear from politicians. We remain very bullish in the outlook for Canadian energy stocks.
We got to leave it there, Eric. We're out of time. Thank you for your time. We will see you again tomorrow here on Market Call.